Hey guys, welcome back to my channel. Today we are diving into the fascinating world of behavioral finance where we explore the psychology behind the money market. Get ready to embrace the hidden forces that drive our financial decisions. Let's jump right in. Have you ever wondered why people sometimes make irrational financial choices? That's where behavioral finance comes into play. It combines the fields of psychology and economics to help us understand why we behave the way we do when it comes to money. Emotions play a significant role in our financial decision-making process. Fear, greed, and overconfidence can cloud our judgment and lead to poor investment choices. We'll delve into the impact of these emotions and how they can influence our financial well-being. Our brains are wired to take shortcuts and make quick decisions. However, these cognitive biases can often lead us astray. We'll explore common biases like confirmation bias, availability bias, and anchoring, and how they affect our investment strategies. Humans are social creatures, and we tend to follow the crowd. The herd mentality can drive market trends and create bubbles or crashes. We'll discuss the psychology behind herd behavior and how it impacts the money market. Behavioral finance is a branch of finance that studies how human emotions, cognitive biases, and social influences affect the behavior of investors, traders, and financial practitioners. It challenges the traditional assumption that people are rational, self-interested, and consistent in their financial choices. It recognizes that people are often irrational, emotional, and influenced by various psychological factors that can lead to suboptimal and unpredictable results. Behavioral finance is not a new concept. It has its roots in the works of psychologists, such as Daniel Kahneman, Amos Tversky, and Richard Thaler, who developed the prospect theory, the loss aversion theory, and the nudge theory, among others. These theories explain why people often deviate from the expected utility theory, which assumes that people make decisions based on the maximization of their expected benefits and the minimization of their expected costs. Behavioral finance also draws from the insights of behavioral economics, which applies psychological principles to the analysis of economic phenomena. Behavioral economics shows how people's preferences, beliefs, and motivations can affect their economic behavior, such as consumption, saving, investing, and trading. Behavioral finance has many applications and implications for the money market. The money market is the market where short-term financial instruments, such as treasury bills, commercial paper, certificates of deposit, and repurchase agreements, are traded. The money market is vital for the functioning of the financial system, as it provides liquidity, stability, and efficiency for the participants. However, the money market is also subject to the influence of behavioral factors that can affect its performance and dynamics. For example, the money market can be affected by the following psychological phenomena. Herding. This is the tendency of people to follow the actions or opinions of a large group, regardless of their own information or judgment. Herding can cause the money market to become more volatile, as people tend to buy or sell the same instruments at the same time, creating bubbles or crashes. Overconfidence. This is the tendency of people to overestimate their own abilities, knowledge, or skills, and to underestimate the risks or uncertainties involved in their decisions. Overconfidence can cause the money market to become more inefficient, as people tend to trade more frequently, incur higher transaction costs, and ignore relevant information or feedback. Framing. This is the tendency of people to be influenced by the way a situation or a choice is presented or worded, rather than by the underlying facts or outcomes. Framing can cause the money market to become more biased, as people tend to react differently to the same instrument or situation, depending on how it is described or labeled. Anchoring. This is the tendency of people to rely too much on the first piece of information they receive and to adjust their subsequent judgments or expectations based on that initial anchor. Anchoring can cause the money market to become more rigid, as people tend to stick to their initial beliefs or estimates and to resist changing them in light of new information or evidence. These are just some of the examples of how behavioral finance can help us understand the psychology of the money market. By being aware of these psychological factors, we can also learn how to overcome or mitigate them and to make more rational and optimal financial decisions. Here are some of the tips and strategies that behavioral finance suggests for improving our financial behavior in the money market. Seek diverse and independent information. One of the ways to avoid herding is to seek different sources and perspectives of information and to form our own opinions based on our own analysis and evaluation. This can help us to avoid being influenced by the crowd and to discover undervalued or overvalued opportunities in the money market. Be humble and realistic. One of the ways to avoid overconfidence is to acknowledge our own limitations, biases, and errors, and to seek feedback and learning from our experiences and outcomes. This can help us to avoid being too arrogant or reckless, and to adjust our strategies and expectations according to the changing market conditions. Focus on the substance and the process. One of the ways to avoid framing is to pay attention to the actual facts and outcomes of a situation or a choice, rather than to the superficial or irrelevant aspects of how it is presented or worded. This can help us to avoid being misled or manipulated by the framing effects, and to make more consistent and objective decisions. Update and revise your beliefs and estimates. One of the ways to avoid anchoring is to constantly update and revise our beliefs and estimates based on the latest and most relevant information and evidence. This can help us to avoid being stuck or biased by our initial anchors, and to adapt and respond to the new market developments. Behavioral finance can help you improve your personal finances by making you aware of the psychological biases that may affect your financial decisions. Let me provide some examples of how you can apply behavioral finance to your personal finances. To avoid overconfidence bias, which is the tendency to overestimate your own abilities, knowledge, or skills, you can seek feedback and learning from your financial outcomes and adjust your strategies and expectations accordingly. You can also diversify your portfolio and avoid putting all your eggs in one basket, as overconfidence can lead to excessive risk-taking and underestimating the uncertainties involved in your investments. To avoid loss aversion, which is the tendency to prefer avoiding losses over acquiring gains, you can focus on the long-term performance of your investments rather than the short-term fluctuations. You can also set a clear and realistic goal for your desired return and stick to it rather than being influenced by your emotions. You can also use a systematic and disciplined approach to investing, such as dollar-cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of the market conditions. To avoid herd behavior, which is the tendency to follow the actions or opinions of a large group, regardless of your own information or judgment, you can seek diverse and independent sources of information and form your own opinions based on your own analysis and evaluation. You can also avoid being influenced by the media hype or the fear of missing out, and instead focus on the fundamentals and the intrinsic value of your investments. To avoid framing, which is the tendency to be influenced by the way a situation or a choice is presented or worded, rather than by the underlying facts or outcomes, you can pay attention to the actual facts and outcomes of a situation or a choice, rather than the superficial or irrelevant aspects of how it is presented or worded. You can also avoid being misled or manipulated by the framing effects and make more consistent and objective decisions. To avoid anchoring, which is the tendency to rely too much on the first piece of information you receive, and to adjust your subsequent judgments or expectations based on that initial anchor, you can constantly update and revise your beliefs and estimates based on the latest and most relevant information and evidence. You can also avoid being stuck or biased by your initial anchors, and adapt and respond to the new market developments. As technology advances, so does our understanding of behavioral finance. Artificial intelligence and machine learning are being used to analyze vast amounts of data and predict market behavior. Understanding the interplay between our minds and money is crucial for financial success. Behavioral finance is a fascinating and complex field that can help us understand the psychology of the money market. By applying the insights and principles of behavioral finance, we can improve our financial behavior and outcomes in the money market. We can also embrace the psychology of the money market and use it to our advantage rather than to our detriment. Join us next time as we continue to uncover the fascinating world of finance. Don't forget to like, share, and subscribe to our channel for more captivating content. Until then, happy investing.